Hello everybody, welcome back. This is episode number 19 of the Trading Bootcamp series, and in this episode we will be diving into Standard Deviation Part 2. I've made in my latest video of the Standard Deviation that I was going to be giving you guys a deep dive on the next video, therefore that is what I'm going to do today. We are going to be discussing a deep dive of the Fibonacci tool and a deep dive of the Standard Deviation modification. Now let's start with the deep dive of the Fib tool. So before we actually do these deep dives, I just want to tell you guys something, that the Standard Deviation is a part of the Fib. The Standard Deviation is just a modification of the Fib, and that's why I am going to show you guys the modification right now. I've shown you guys in the last video, but I just wanted to make things clearer even now. So here's the template that you need to know. I can let you guys a little bit of time. And yeah, you took a print already. That is the modification of the Standard Deviation and my Fib tool, because they are both combined. I combined the Fib and the Standard Deviation as well. But now let's look into this right side where we have the deep dive of the Fib tool. Now, all of these levels that you see, I'm going to explain what are these in the Standard Deviation modification. But to actually start things off, I will start with the Fib. So the Fib consists of mainly these four levels, also the range, because it's from 0 to 1, and also you have some projections. The projections are areas that price can be overbought and oversold. I will show you guys what is that. And with the Fib tool, it usually is 1.6a and then 2 point something like that. But the guys that use the Standard Deviation, we like to just abbreviate that to -1, -2. These are really important areas because I will show you just an example that of a trade that I actually took on Friday, so yesterday, which was a banger trade. I got a 1 to 2.5 on it. It was a banger trade, and I will show you how I actually caught with the Standard Deviation, so you guys can also learn and also develop your Standard Deviation skills. But now let's look into the Fib. So you have the range. First, you need to know how to mark off the range. As I mentioned in the previous video, the range is marked out by having a consistent accumulation, then boom, a point where the manipulation is going to happen. This, you need to have the basics of the Power 3, which if you don't know that, I would recommend watching my Power 3 video. I'll put it right here. But for you to actually know how to anchor the Fib tool or the Standard Deviation, you need to know of the three periods: the accumulation phase, the manipulation phase, and the distribution. That is my strategy. That is beautiful and lovely. So you have the accumulation phase, and then you have the point where the manipulation phase starts. So in this case, boom, the manipulation happens right there, and then you get the inverse and the change. Let's say that, right? So you get this little change. You can see right here, this little change, and you get this little inverse, therefore an A plus for you. So you can enter right off the change, right? Where would you anchor your Standard Deviation? Would you anchor it from the lowest point of the accumulation to the highest? Sometimes. Would you anchor it to the start of the manipulation, to the top of the manipulation? No, because in this example, since we're bearish, you need to actually anchor it from the opposite side, because you got to see Fib tool and the projections that it has. If you're bearish, you anchor it from the top to bottom. So let me actually recap on that. If you're bearish, you anchor from top of the move to the bottom. Always like that. The range and where you actually anchor it is different on the bullish side, because the bullish side, you anchor it always from the low to the high. So normally, where you have bearish examples, you're going to anchor it from the right to the left, and with bullish examples, you're going to anchor it from the left to the right. Always up or always down. The zero, if in this example, since this is a bearish example, the zero has to always be at the lowest point in a bearish example, and in a bullish example, the zero has to always be in the top of the move, so you can actually anchor into your levels. And that is also the main thing to anchor the Fib tool. And I'm going to explain you guys right now how can you actually identify these anchor points. So you can actually know this by, as I previously mentioned, by the beginning of the manipulation phase, right? That is an anchor possibility, and from the lowest point of the accumulation. But now, since the lowest point of the accumulation is normally where you're going to say your break even, right? Because that is the main point of the power 3. You normally say your break even at the accumulation high or low, right? Since that is the case, you are not going to be anchoring right there. Because if you have a point that you're going to be interested, that you know that it's going to have some resistance or some reaction to price, for example, an accumulation low, because it's a significant internal range liquidity, right? If you know that is going to happen, you are not going to anchor it from the low to the high. That is not going to happen. And also in the bearish example, you never anchor it from the low to the high. You always anchor it like this, if you would. But normally, and most of the times, that's why I'm only going to teach you guys this one, because it's the simplest one and it's the one that happens most frequently. It's from the manipulations high to the start of the manipulation. So as soon as you see a slight pullback and it actually breaks this area of accumulation that you're having, that is your gal to actually anchor it from here to here. From here to here, right? Pretty simple, pretty straightforward. And let's now look into these levels. So as I mentioned in the previous video, you have the 0.5 level. This is, in this example, since this is a bearish example, this is going to be your discount price. Discount acts as a safe haven for if you want to go on sell trades, because you gotta understand something. This is financial markets. We always want to buy low and then sell high to make the highest profit ever. So humans, especially banks and institutions, they are no different from this rule, right? So if you have this move, for example, where would price be going next? Would it be pushing down? Normally, no. Because when it pushes down, it's actually overcommitting itself and it's actually overselling itself. Therefore, it has to have a slight pullback or even a big pullback. If it oversells too much, we'll look on it on the RSI that I have right here. We'll look in it after. But if it's oversold, it usually, and it's always going to be tapped into a premium zone, because premium zones are the areas that price is the highest, that investors and banks can actually move their money and move the positions to actually sell and make the highest amount of profit. But now, where does that level even come from? The 0.5. But if you want to be even more specific, it's these two levels, the 0.62 and the 0.705. This is my favorite because this is basically almost the midpoint of the move. Since the midpoint is already powerful, if you have a premium of a premium, so as an example, in this case, this all is a premium, and this is the premium of the premium. Therefore, if price can be in this range and actually pump into the premium of the premium, and then investors are going to start selling hard because price is overbought or price is way too valuable, therefore they need to sell high. When they sell high, they're going to make the most amount of money. Therefore, that's why they're going to be moving even more positions into this area. Therefore, price is going to quickly flush. You see? You understand me? Whereas the 0.62 is the safe haven area and also the guardian, just because normally, since this premium of the premium, it's a little too high. Normally, in this case, if sellers are way too powerful, price doesn't even reach this area. It usually taps this one and then inverses, right? It normally does not go into the 0.5 and just stay like this. It normally doesn't do that. It normally doesn't just tap the 0.5 and go back down. That's not what it does. It normally reacts off of the 0.62 and then goes back down. Now, if sellers are losing volume and losing momentum, getting into this premium of the premium is actually going to be your block. And once price passes that premium of the premium, which in that case will be the 0.79, this one, this level means if a candle body closure happens above this level, a bullish one, it means that the premium of the premium, therefore this safe haven, is now invalid. Price is just going to create a breaker structure, retest again, and then go back up because sellers lost momentum. Sellers lost the market against buyers. Pretty simple, pretty straightforward. Little recap. we have this range. The 0.5 in a bearish example is a premium, and a bullish example is the discount. Well, and then the 0.62 bullish or bearish example is the same thing. It's going to be an area where price wants to manipulate and then go back down. In this example, it's the safe haven. And if price is overbought right here, it taps the premium of the premium, which this is the this is the premium, and this is the halfway, and this is the half move of the premium, therefore the premium of the premium. The highest point where it can be sold is this one. Once price closes above this point, it's all gone. And yeah, that is the FIB tool. Really, really easy, really explained. And yeah, let's now look into the standard deviation. Standard deviation is the exact same thing of the FIB. The exact same thing. However, the anchor points are a lot different. What is an anchor point, you may ask? The anchor point is where you put your 0 and your 1. But in this case, as you can see, you have all of these other values. You have the -1, the -2, the -2.5, and then the -4 below. These are areas where price is going in a bearish example. These -1 and -2 areas and -4, these are going to be areas where price is oversold. Therefore, it needs to be bought back up. Therefore, once price reaches these areas, it usually tends to accumulate or explode inversely. So now, how do I know if a trade is going to inverse on my position where I am right now, just based off these levels? Two things. If first of all, if price comes to these levels and starts accumulating, nothing much of it, and then breaks below, I'm good, because I know that this level cannot be supported. Therefore, sellers are still winning the market, which is really good because buyers, even though buyers bought back up, sellers just kept pushing price down in a overbought area, therefore a premium, and then price just started shitting itself again. But now, if the opposite thing happens, if price goes here and then explodes back up because it's oversold, right? Price needs to be bought back up. If the buy happens way stronger than the sell, and if you're in a sell position and you notice that there's a huge impulsive candle, huge impulsive moments right here, even if it's accumulating, but then you have all of these sudden impulse, you can close your position in a profit because you know that this area is going to be either very resistible and accumulative, is going to bring exhaustion to your markets, it's going to be exhausting your strategy and your trade. Therefore, you should leave and make at least a little bit of profit. And now I am going to show you, right here. This is, if you guys don't know, the RSI. I know you guys like this or don't like this. I'm not a big fan of it, but shit, my fucking throat. You guys might not be a fan of it, and I'm not neither, but it is what it is. It is what we have. But the RSI is actually really important because you can tell if price is oversold or overbought. As you can see in this example, price, let me actually put it right here. Price is overbought right here, therefore it went to a little sell-off to actually sell and come back into place. The RSI stands from the 30 to the 70 range, and this blue or purple line indicator, once it breaks above that 70 or below that 30, above means overbought. Therefore, it needs to be sold to go into this equilibrium again. And if it comes below this 30, it needs to be overbought so it can be controlled again. And then this yellow line is just the average of everything right here. So you can see all of this accumulative state of the purple line. In this example, the purple line was in accumulative state right here. Therefore, the yellow line is just going to follow. And then right here, we have this huge explosiveness. Therefore, since the yellow line is just the, I forgot the name of it. How did I say this? Oh, man, I got a blank. The yellow line is just like the purple line. I mean, you know what I mean, right? It's just like these all, I can only know the word in Portuguese right now. Really embarrassing, but it is what it is. I forgot what I was saying. I lost my shit. I'm sorry. Not happen again, but it is what it is because I have too much thing that I have to talk. That's why I get lost. Now, this was the trade that I took on Friday. As you guys can see, we were in this. Let me actually put this a little bit lower. We were in this range, and let me put it right here. We were in this kind of range. We were bullish for today on the market maker model. And then we tapped into this beautiful 50-minute, where as you can see, this is what? This is going to be our accumulation state. And this is wrong. Yep. This is going to be our accumulation, and this is going to be our manipulation where it touched the 50-minute, and then we have the inverse and the change. I entered off of this big impulsive of the change, and then I was targeting the slow, which was actually a pretty good trade. Now, where did I anchor the standard deviation? As you guys can see, let me actually do a little recap. I anchored it from from the highest point to the lowest point, right? That is how it is. Highest point to lowest point. Now, I said normally it is from right to left. How do you mark this? However, you can clearly see that there was a little resistance, right? What was this resistance? This resistance was for something, because if you go and grab your Gann box, you can actually see the midpoint was touched. The midpoint of this move got touched, therefore price went into a premium. If price goes into a premium, in this example, since this is a bearish example, if price goes into a premium, this little pullback can mark ourselves as the other manipulation. Therefore, you can anchor it from the highest point to this beginning of the pullback move. And that is going to set off your standard deviation for the entire trade. Well, I set break even on this New York low. And then I targeted this low. But now let's actually see the values, because that is what is really important. You can see the 0 and the -1. What happens, when price touched the -1? I drew a line right here. You guys can see the -1. When price hit the -1, look what happened. It inversed. It did not inverse to the point where it stopped me out at break even. No. It inversely created a little bit of a pullback, a little bit of resistance against sellers because price was oversold. Because you can see in this RSI indicator, look at what I'm pointing. You can see right here the day below, right here. It's Friday 10:45. You can see this little gray dot that's going around. Look, once price touched the -1, look what happens right here. It's below the 30. It's below, see, look, this is the 30 level. It's below the 30. Therefore, price is oversold. What does it have to do? It has to buy itself back up. But now, did it buy itself to the point where it actually exhausted sellers? No, because look what happened in the next candle. You got a huge market structure shift. Therefore, I confirmed that this was a valid, and I could keep holding this just because of this valid market structure shift, and also because I didn't see on the RSI because I don't trade with it, but I just knew by head that price was oversold in this level. Therefore, it was brought back up. Sellers sold at a premium, so sellers had the advantage, because if you go and anchor it from the high to the low, you can actually see that there is a discount. Therefore, this is the premium. You can see from this pullback candle to this low, you have the premium. Sorry, you have the 0.65. You have the 0.5 level. See, it actually touched the 0.62 and then it went back down. That is really, 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 really easy. And then let's look at the other example, the -2. -2 caused a little bit more of issues because when price touched this -2, look what happened. -2 got touched, and then boom, huge explosive move up, because look at the RSI. Mega oversold right here. Mega oversold. Therefore, price had to be violently bought back up to even things out, which was the thing that happened. But now, why didn't I sell right here and took profits? Well, because of this one thing. This point is a significant resistance. Sorry, this point is a significant point of liquidity. Price could just come here, sweep this, and go back down. Most people put their stop losses in this wick, which is good. It's a protected high, but I wouldn't, just because of the fib, because this standard deviation fib, this level can actually create such a resistance that it pumps back up, sweeps you out, and then goes back down because it has all of this liquidity above, all of these positions that sellers were on, because sellers are attacking right now, attacking, right? And if you go check at the range again, if you go check at, and if you anchor it another fib from the highest point to the lowest, look what happened. Price touched it's like butter. It always works. Look, the 0.5 level is right here. Price is in a bearish trend. You have this premium is right here. And then look what happened. The 0.705, it touched and then boom, explosive back down. Once it touched the premium of the premium, it exploded violently back down. Therefore, by confirming this with this candle as well, this candle, which marked the market structure shift, therefore the continuation, that price was going the direction of price was going, which was the market structure shift. As I mentioned, I knew that this was going to be a winner trade, which was the case. You can see how quickly things happen in the markets, and you can see how perfect they align with what we just learned today. We learned, for example, how to anchor it. We learned that from this range, price touched the -2, created, it was mega oversold, and then was bought back up because it had to, right? It was at a disadvantage for sellers right here because they were not making any profit. Price was oversold, they sold too much. Now selling at this level would be too costly, would mean no profit because it was already low. Therefore, they have to buy price back up, manipulate price back up into the 0.705 or the premium of the premium move, and then boom, explodedly, and then violently exploding down to the direction that price always wanted to go in the first place. Yeah, this is part 2 of the standard deviation. I gave you guys an example of my trade. I gave you guys the combination of the fib and the standard deviation as well. You guys can see the power 3 right here beautifully without me even explaining the accumulation, the manipulation, and the distribution phase. Beautiful trade, and yeah, beautiful people that are watching. Beautiful video, and I hope you guys enjoyed everything that I talked about right here. I will have to figure things out because I'm running out of ideas a little bit on what I can present to you guys on episode number 19 or 20. I think it's the 20th episode, which is going to be a little bit good. And yeah, I hope you guys enjoyed this video, and God bless.